Somewhere in a boardroom right now, there's a guy in a suit explaining to retail investors why they should be excited about something most of them will never actually understand. SpaceX is going public. And before you scroll past this thinking it's just another tech IPO, here's the thing that should actually scare you a little. This isn't Snapchat. This isn't WeWork. This is a company that controls launch access to space, has contracts with the Pentagon, runs the only reliable satellite internet network on the planet, and might be worth more than most countries' entire economies. And in a few months, your 401k is probably going to own a piece of it whether you understand what just happened or not. Most people think IPOs are simple. A company sells shares, the stock starts trading, you can buy some if you want. Done. But SpaceX going public isn't a normal IPO. It's a structural event that's about to ripple through index funds, pension funds, and retirement accounts in ways almost nobody is talking about. And if you don't understand what's coming, you're going to make some decisions in the next year that you might regret for a decade. My name is Usman, and I spend way too much time thinking about money, markets, and the mechanics that quietly shape your financial life without you ever being asked for permission. If you want to actually understand what's about to happen instead of just reacting to headlines, make sure to hit that subscribe button and give this video a thumbs up if it helps you see this differently than the financial media is presenting it. Now, before we get into why this is so much bigger than people realize, let me ask you something. When you think about your 401k, what comes to mind? Probably a number on a screen. Maybe a target date fund you picked 5 years ago and haven't looked at since. Most people treat their retirement account like a black box. Money goes in, a number goes up, and the actual mechanics of what's happening inside stay completely invisible. That's by design, by the way. The entire index fund industry is built on the premise that you don't need to think about it. Just contribute, diversify, don't touch it. And for the most part, that advice is good. But every few years, something happens that exposes just how much is actually going on inside that black box. And SpaceX going public is about to be one of those moments. Here's what most people don't realize about how index funds actually work. When you invest in something like a total market index fund, you're not picking and choosing companies. The fund is built to mirror the actual market. So when a massive new company gets added to that market through an IPO, the fund has to buy it. Automatically. Without asking you. Without asking the fund manager whether they think it's a good investment. It's mechanical. If SpaceX goes public at a valuation anywhere close to what's being discussed, somewhere in the range of $400 to $800 billion depending on which leak you believe, it would immediately become one of the largest companies in the index. Which means index funds holding hundreds of millions of retirement accounts would be forced to buy in, automatically reallocating your money toward a company you never specifically chose to own. This is the part most financial content completely glosses over. People are going to wake up one day with meaningful exposure to SpaceX in their 401k, and they won't even know how it happened. But here's where it gets really interesting. Because most people assume this means free money is coming. New hot stock, automatically added to your portfolio, line goes up, congratulations. And look, that might happen. But the assumption that a massive new addition to the index is automatically a win for your portfolio is exactly the kind of thinking that's gotten people burned in every major market event for the last century. Let's talk about what actually happens mechanically when a company this large joins a major index. First, every fund tracking that index has to sell a small slice of every other holding to make room for the new position. That's not optional. If SpaceX enters at a 1.5% weighting in a major index, funds have to trim their other 500-plus holdings proportionally to fund that purchase. You're not just gaining exposure to SpaceX. You're involuntarily reducing your exposure to everything else you already owned. Second, and this is the part that should genuinely concern you, the price you pay for that exposure is determined entirely by where the stock happens to be trading on the day the index rebalances. Not what it's actually worth. Not some carefully calculated fair value. Just whatever number the market has assigned it on a random Tuesday, which after a hyped IPO is very often inflated by speculative buying that has nothing to do with the underlying business. This has happened before, and the historical examples are not encouraging. When Tesla joined the S&P 500 in December 2020, it entered at a valuation north of $600 billion despite the company having barely turned a consistent profit. Index funds were forced to buy in at that price, regardless of whether it represented genuine value. Tesla proceeded to drop more than 65% over the following 2 years before partially recovering. Every index fund holder who got that automatic exposure took that ride whether they wanted to or not. Same story with companies like Uber, Snap, and a long list of high-profile tech IPOs that entered public markets at valuations that turned out to be wildly optimistic. The pattern is remarkably consistent. Hyped private company goes public. Index inclusion forces broad ownership at peak enthusiasm pricing. Reality eventually catches up to valuation. Millions of retirement accounts absorb the correction without ever having made an active decision to take that risk. So why would SpaceX be any different? Honestly, it might not be. And that's exactly the point most people are missing. Here's what makes SpaceX uniquely complicated compared to a normal IPO. This isn't really one company. It's effectively 3 or 4 different businesses wearing the same trench coat. There's the launch business, which actually has real, provable revenue from government and commercial contracts. There's Starlink, the satellite internet division, which is growing fast and has genuinely disruptive potential but is also burning enormous amounts of capital building out infrastructure. There's the deep space and exploration ambitions, Mars colonization, Starship development, which are wildly expensive, wildly long-term, and wildly difficult to value using any conventional financial framework. And there's the defense and intelligence contract business, which is lucrative but comes with its own set of risks tied entirely to government relationships and political dynamics that can shift overnight. When you buy shares in SpaceX, you're not buying a clean, easily understood business like you would with a company that sells one type of product through one type of channel. You're buying a bet on whether this entire combination of businesses, some profitable today, some theoretical and decades from profitability, justifies a valuation that would place it among the most valuable companies on Earth. This is exactly the kind of complexity that retail investors, and frankly most professional ones, are terrible at pricing accurately. And it's exactly the kind of complexity that gets resolved not through careful analysis, but through whatever the market's emotional temperature happens to be on IPO day. Now let's talk about why your 401k specifically is about to get pulled into this, even if you've never bought an individual stock in your life. If you're like most people, your retirement account isn't sitting in cash or in some carefully curated selection of investments you researched yourself. It's almost certainly sitting in some version of a target date fund or a total market index fund, because that's what most employers default you into, and frankly, it's good advice for most people most of the time. The problem is that good advice for normal market conditions doesn't account for moments like this one, where a single IPO is large enough to meaningfully shift what you actually own without you doing anything at all. Here's the math that should make this click. The S&P 500 currently sits around $50 trillion in total market capitalization. If SpaceX enters at the lower end of valuation estimates, say $400 billion, that alone would represent roughly 0.8% of the entire index. If it enters at the higher end of the rumored range, closer to $800 billion, you're looking at somewhere around 1.5 to 1.6%. That might not sound like much. But remember, the index is weighted by market cap, which means SpaceX entering at that size would immediately rank it among the 15 to 20 largest companies in the entire index, ahead of household names that have been publicly traded and scrutinized by analysts for decades. For comparison, that's a bigger initial weighting than companies like Coca-Cola, McDonald's, or Disney currently hold. Companies with decades of public financial history, transparent earnings reports, and predictable business models. SpaceX would be entering at a comparable size with almost none of that transparency, because private companies don't have to disclose financials the way public companies do, and even after the IPO, there's typically a lag before the market really understands what it's actually pricing. So here's the uncomfortable reality. Within a relatively short window after this IPO happens, a meaningful percentage of your retirement savings could be tied to a company whose actual financial health you have almost no ability to independently verify, purchased at a price determined by IPO hype rather than fundamental analysis, and you won't have made a single active decision in that process. But here's the part that most people completely miss, and it's honestly the most important thing in this entire video. This isn't actually a story about whether SpaceX is a good or bad investment. Nobody, including the so-called experts who will spend the next year on financial television confidently predicting its trajectory, actually knows that yet. This is a story about something much bigger. The complete disconnect between how passive investing is marketed to regular people and how it actually functions during major market structure changes. The entire pitch behind index investing, and it's a pitch I generally agree with, is that you don't need to pick stocks. You don't need to time the market. You don't need to understand individual companies. Just buy the whole market and let time and diversification do the work. And for the vast majority of your investing life, that's true. But that pitch quietly assumes the market itself is relatively stable in its composition, that no single event is large enough to meaningfully distort what passive ownership actually means at any given moment. SpaceX going public is exactly the kind of event that breaks that assumption, at least temporarily. And it's not the first time, and it absolutely will not be the last. As more massive private companies eventually go public, OpenAI being the most obvious future example, this pattern is going to keep repeating. Huge, hyped, hard-to-value companies entering public markets and immediately forcing their way into the portfolios of people who have never made an active decision about them. So what do you actually do with this information? Because I know the instinct here is either panic or apathy, and both of those responses are wrong. Let's start with what you shouldn't do. You shouldn't try to preemptively sell off your index funds because you're worried about one company's IPO. That's an overreaction that will almost certainly cost you more in missed market growth than it could ever save you from a single risky position. The entire value of index investing comes from staying invested through exactly this kind of uncertainty, not from trying to dodge every individual event that makes you uncomfortable. You also shouldn't rush out and try to buy SpaceX shares directly on IPO day because you're worried about missing out. IPO day pricing is some of the most emotionally driven, least rational pricing you'll ever encounter in financial markets. Buying into peak hype because you're scared of missing exposure is exactly the behavior that turns a reasonable long-term strategy into a reactive, fear-driven one. Here's what actually makes sense instead. First, understand that your exposure to SpaceX through index funds, whatever it ends up being, is going to be relatively small in the context of your overall portfolio, even if it makes headlines. A 1 to 1.5% allocation forced through index inclusion is not going to make or break your retirement, no matter how the stock performs in its first few volatile years. The psychological impact of seeing a hyped name appear in your portfolio is usually much bigger than the actual financial impact. Don't let headline anxiety distort decisions that should be based on math. Second, resist the urge to check your portfolio breakdown obsessively once this happens. I guarantee you financial media is going to spend months breathlessly covering every twitch in SpaceX's stock price after it goes public. That coverage is designed to generate engagement, not to help you make better decisions. The volatility in the first 12 to 24 months after a hyped IPO is almost always dramatically higher than what the stock eventually settles into once the market has more information to work with. Watching that volatility in real time and reacting to it is a guaranteed way to make emotionally driven mistakes with money you were supposed to be holding for decades. Third, and this is the genuinely useful part, use this moment as a forcing function to actually understand what you own. Most people have never looked at the top holdings in their own 401k. They couldn't tell you if they're 60% US stocks or 80%. They couldn't tell you their expense ratio. They couldn't tell you whether they're overweight in tech relative to a truly diversified portfolio. SpaceX entering the index is a perfectly good excuse to actually open your retirement account, look at what you're holding, and make sure your overall allocation still matches your actual risk tolerance and timeline. Not because of SpaceX specifically, but because most people are overdue for that check regardless of what triggers it. Fourth, if you do want direct exposure to SpaceX beyond what index inclusion gives you automatically, treat it the way you'd treat any single, highly speculative position. Small percentage of your overall portfolio, money you can genuinely afford to lose entirely, and a clear understanding that you're not investing in a proven, transparent business with decades of public financial history. You're investing in a bet on whether an extraordinarily ambitious, extraordinarily complex collection of businesses can grow into a valuation that's being set largely by hype and scarcity rather than current fundamentals. That doesn't mean it's a bad bet. It means it's a bet, and you should size it accordingly. Now here's something that I think gets lost in literally every conversation about hyped IPOs, and it's worth sitting with for a second. The companies that quietly compound wealth for regular investors over decades are almost never the ones generating this level of headline excitement at their public debut. Amazon's IPO in 1997 was barely covered outside financial publications. Most people had never heard of it. Costco going public didn't make anyone's must-buy list. Meanwhile, some of the most hyped IPOs in history, the ones that dominated headlines and got automatic index inclusion treatment because of sheer size, ended up being some of the worst performing major holdings for years afterward. The correlation between IPO hype and long-term investment performance is, generously, weak. Sometimes it's actually negative. This isn't a prediction about SpaceX specifically. Nobody can honestly make that prediction right now, and you should be deeply skeptical of anyone confidently telling you otherwise. It's an observation about a pattern that's repeated enough times that it's worth internalizing before the next hyped IPO, and the one after that, and the one after that. Here's the bigger picture that I want you to walk away with. The financial markets are not a static thing that you set and forget forever. They're constantly evolving, constantly absorbing new companies, new structures, new sources of complexity. Index investing remains one of the best tools available to regular people precisely because it doesn't require you to predict every individual event correctly. But understanding the mechanics behind these events, understanding why a company you never chose to buy is about to show up in your retirement account, understanding why that's neither automatically good news nor automatically bad news, that's what separates an investor who reacts to headlines from one who actually understands what they own. SpaceX going public is going to dominate financial media for months. There will be breathless coverage of every price swing. There will be confident predictions from people who have no actual ability to predict this. There will be pressure to feel like you need to do something dramatic in response. You don't. What you need to do is understand what's actually happening mechanically, recognize that your exposure through index funds will be proportionate and relatively contained, resist the urge to make emotional decisions based on headline volatility, and use this as a moment to actually understand your own portfolio rather than blindly reacting to a single new name appearing in it. Your retirement isn't going to be made or broken by SpaceX. It's going to be made or broken by the same things it was always going to be made or broken by. Consistent contributions. Reasonable diversification. Staying invested through volatility instead of reacting to every headline. The companies will keep changing. The fundamental rules of building wealth through patient, disciplined investing won't. Your future self isn't worried about whether SpaceX hits its valuation targets. They're worried about whether you stayed the course when the headlines got loud. Don't let a single IPO, no matter how historic, talk you out of the strategy that actually works.